Gold trading above $4,000 once again in record territory. Is this a worrying sign that investors really are concerned about fiat currencies, in particular the US dollar? Let's get more from John Zechner, chairman and founder of J. Zechner Associates. What do you think? Great to see you, John. Thanks for joining
Hey,
us.
Hey, Andy.
What do you think? Is this almost like cans of beans and can opener trade? People are so worried about the future, they're thinking, I better own some gold.
Well, I don't know if I go to that extreme, Andy, but it's something, the people have been, positive, bullish on gold, ourselves included, for a while now, have been looking for. I mean, it's a diversification away from the US dollar. And I think what's gone on in the US in the past year in particular with, the trade wars and the deficit and everything like that, and the obviously tariff, is that you maybe are accelerating that move. So gold is a small market compared to these massive currency markets, and it doesn't take much to move it over. And the biggest buyers have been the central banks, and these guys are long-term players. They're not traders. I mean, we've probably seen this last move to the upside, which is, I think, even surprising the bulls how aggressive it has been. Maybe that's the public jumping in a little bit more. But no, I think what you look at it, Andy, is they want to diversify away from fiat currency. So if you're going to go away from the US dollar, if that's, losing its reserve status after almost, 80 years of that, almost since the end of the Second World War when it took it over from the pound, if that's moving away, so where is these foreign reserves going? The euro, yeah, some of it has, the yen, some of it, Chinese yuan, no way. There's just not the liquidity and the safety that people are comfortable with. And if you continue to depreciate the value of the US dollar, you're going to just see more money flow into gold, and that ultimately is a solution for US debt as well. I hate to say it, it's a South American solution. I mean,
Hmm.
how do you get out when your liabilities are running as high as they are, when you're running a 6% deficit to GDP in good times, never mind, bad times. When you're doing that, you're piling up so much debt. So, how do you get out of that? Is you depreciate the value of your currency, which effectively depreciates the value of your debt to all the foreign holders of that.
Hmm.
And that's, to me, sort of the escape plan. So central banks logically are moving away from that. Now, gold is different on a supply demand basis, Andy, as you know, because the old story. I mean, it's not a commodity like lumber or oil is consumed, and then not available anymore. I
Hmm.
mean, the old story: every ounce of gold that was ever mined is still out there in some form. So, the supply demand dynamics are not going to change in terms of moving the price. What I think you might see a little bit more of in the shorter term is
Hmm.
some of these other gold coming back in, like, I don't know, maybe people melting down jewelry and other things to create, secondary supplies out there. That might mitigate the further price rise a little bit. But for now, the stocks are still cheaper than they have been in decades relative to the price of gold. And I think most Canadian money managers, are probably underweight in their equity allocations to gold stocks. So I think this continues. I mean, the harder thing with the gold stocks, Andy, is finding, safer geopolitical jurisdictions, that you're not at risk. We've seen what's happened
Hmm.
in Mali and all of that with Barrick and other things in some places in South America.
Hmm.
And, where some of the valuations have gotten a little excessive. So we're trying to find, the companies that meet those sort of criteria in between, and we, keeping the money in there.
John, we're going to get into some stocks you like the look of in a sec, but maybe controlling, you could put up a 1 year chart for Nvidia, because I got it wrong. I thought Nvidia was still down from its record highs, but actually it has now hit new record highs. Nvidia, John? What do you think when you see a stock like that, like Nvidia, blasting to massive valuations north of $4 trillion?
Well, it is, but I mean, Andy, when you look at it, I mean, look at the numbers they're putting up. I mean, that's the bigger story and the bigger question: can it be sustainable? I mean, when this breakout started in 2 years ago, early 2023, these guys were, I think they had a great quarter of 9 billion in sales, and now they're running close to 50 billion in quarterly sales. I mean, they've been massive, and it's, a lot of that is slow to the bottom lines with record high margins because they're simulators for the AI infrastructure as well. So. Yeah,
Hmm.
NVIDIA is not the name that necessarily worries me in tech land about the breakdown. I mean, yeah, it would go down with the rest of the market, but there are other names like, Celestica up here and all, where the valuations are so excessively beyond where they've been in the past, and they're so
Hmm.
dependent on this continued build out of the AI infrastructure and data centers and all of that. But nothing to say it won't happen. And I'm looking at the earnings expectations for next quarter. Tech is
Hmm.
still leading with sort of mid-teens expectations for earnings growth. So the valuations aren't that egregious outside of these pockets we see of speculation that,
Hmm.
they do worry me a lot. And this sort of incestuous equity movements we're seeing beyond, the major players, and the quasi-state capitalism you're seeing in the
Hmm.
U.S. in terms of ownership of the sector as well, and
Hmm.
obviously problems with the Chinese. I mean, there are a few worries out there, but
Hmm.
I don't think you have to run for the hills from Nvidia or the sector, the tech sector in general.
Yeah, so I guess you mean Nvidia investing in OpenAI, and then OpenAI turns around and buys Nvidia chips. Yeah, let's get to some names that the old circular movement of money. Let's get to some names you do like, John, and they include some of the software companies that have fallen out of favor, including Adobe and Salesforce.
Yeah, I mean, we are, I'm not changing my equity weighting dramatically. I mean, it's not particularly aggressive, but I'm looking more where, stocks that have a decent valuation, but they're down and they can continue some earnings growth. I think people have gotten overly negative on the software sector. I mean, there's all these worries that AI is going to displace application software in general. And you look at some of the worst performers this year, SAP, Accenture overseas, Workday, Salesforce, Adobe. I mean, up here, Constellation Software, these things have been hit really hard. And I think, maybe they're overdoing. These companies are not going to rip out their enterprise software that they have, put in place for decades now and spent, hundreds of billions of dollars on for some AI a component that is going to sort of bypass that completely. I mean, it may happen slowly over periods of time, but I think the market is over anticipating or being too pessimistic on that. So that's a bit of an opportunity. That's when I'm sort of looking for general things that have not participated where the valuations are reasonable. So I'm, healthcare in the U.S., energy up here, telecom up here. There's names in those sectors that stick out. Yeah, I'm putting money into that and just sort of, looking at the downside protection a little more. Sort of, if I put my investment stock market strategy, Andy, sort of speaking allegorically, I say, Andy, we're still at the party, but I've stopped drinking and I'm standing close to the doors.
I love that analogy. Thanks very much indeed, John. That's the best line of the day so far. John Zechner, chairman and founder of J. Zechner Associates. Thanks very much, John.